Welcome to the Chartered Accountants Academy video lectures. My name is Davido Paradzai, and in this video lecture, we are going to cover materiality as found in ISA 320 in your handbooks. You will remember the auditor's ultimate goal is to express an opinion on the financial statements of a particular client. How does the auditor tell that these financial statements are materially misstated or these financial statements are not materially misstated? This is because they have set a benchmark. They have set a bar, an amount which they are going to say any amounts which are misstated exceeding this amount will consider the financial statements to be materially misstated. Any amounts misstated but below that figure can be ignored. So this is the concept of materiality used by the auditor ultimately to help express their opinion. Just a recap of what we have covered and where we are now. We are saying block 1, we did corporate governance, we did the CPC, engagement activities, planning. Now, still in planning, we want to determine that amount which is going to be used by the auditor in expressing an opinion to say financial statements are materially misstated or financial statements are not misstated. What are our learning outcomes? At the end of this video tutorial, you should be able to understand the concept of materiality and performance materiality. You should be able to know the steps to applying materiality in an audit and apply the materiality steps to an exam type of question. What is materiality? Those misstatements that may influence the economic decision of users. We are saying if financial statements are misstated, the stakeholders are likely going to be affected by those financial statements. The decisions that they are going to make are based on those financial statements. Therefore, if materially misstated, it will affect stakeholders. This concept of materiality is based on the auditor's judgment. So there are steps that an auditor follows up until they have an amount before they even start to do the actual audit work, so that against that benchmark, they will tell whether financial statements are misstated or they are not misstated. Why does an auditor need to determine materiality? Why does an auditor need to determine materiality thresholds? This is because the auditor will express an opinion on whether financial statements are free from material misstatements. It gives a benchmark for which to determine whether a misstatement is in fact important enough to warrant further consideration. Any amount above the materiality figure likely going to render our financial statements materially misstated will require further consideration. So it is a benchmark for which to determine whether a misstatement is in fact important enough to warrant further consideration. Why is materiality important to us? We are saying there's an inverse relationship between materiality and risk. You will remember we have done risk assessment. Where a client's risk is high, you have done your risk assessment, you have concluded that the client's risk is high. You set your materiality figure at a low. Materiality is minimal, so that you will not lose any amount, you will not lose track of anything within that client because already there is high risk. You want to capture everything so that you will not express an inappropriate audit opinion. Where the risk is low, You have done risk assessment for a particular client. You have concluded that risk is low. Your materiality figure can be high because there is not much that can go misstated within that client. So from your risk assessment, you found that management integrity is questionable, or maybe the instances whereby drivers to help management to engage in fraudulent financial reporting, risk is really high. There is need to lower materiality because you need to do more audit work to avoid expressing an inappropriate audit opinion. So remember, the relationship is inverse. Where risk is high, we are going to lower materiality. Where risk is low, materiality can be set at a high. Therefore, materiality guides how much work we need to do to support the audit opinion. What are the types of materiality? There is materiality for the financial statements as a whole. Then there is performance materiality, which is set at accession level, now using classes of transactions, using account balances. This is to reduce probability that aggregated misstatements, those which are uncorrected and undetected, exceed overall materiality for financial statements as a whole. This is also to deal with specifically risky accessions or accounts. Maybe in the financial statements, you find that trade receivables are risky. You then need to go and determine the materiality for trade receivables. Maybe if it is revenue that is risky, you also need to then go and determine the materiality for revenue. That is performance materiality. We use performance materiality level to assess risk and develop audit nature, timing, and extent of audit procedures. This risk at accession level for a particular account balance or for a class of transaction is we use performance materiality level to assess risk and develop audit nature, timing, and extent of audit procedures. This is because at accession level, we have found information to do with the risk associated with our trade receivables, risk associated with our revenue. Therefore, what type of procedures are we going to do? Are we going to do test of controls? Are we going to do substantive procedures? At what point are we going to do it at interim, or we are going to do it at year end, and the extent of the audit procedures that are going to be performed? So we have materiality at overall financial statement level, then materiality at accession level, where we are going to the financial statements and picking a line item that we want to determine its materiality. So, what are the steps in applying materiality? You want to determine materiality and performance materiality for the financial statements. This guidance is found in ISA 320. If necessary, determine materiality and performance materiality for classes of transactions, account balances, or even disclosure, also guided in ISA 320. Plan and perform the audit procedures. Then, from the work that you have done, you evaluate the audit findings ultimately, because the auditor wants to express an audit opinion on the financial statements. Materiality is first assessed at planning phase, but then it is a concept that the auditor needs to continuously reassess as they perform audit work. New information may be available to them, and they continuously need to assess materiality for a given client. So now, calculating materiality practically. You are saying, looking at a particular entity, what is of most importance to the users of the financial statements? If it's a mining company, will the statement of financial position be of most importance, or will it be the income statement? Are they mainly worried about their revenue? Are they mainly worried about their profits? Or is it a combination of both? Or is it a combination of both statements that you're going to use for you to determine your materiality? So an entity with heavy equipment, heavy assets, they will likely be looking at your statement of financial position. For a profit-oriented entity, maybe they are likely worried about this income statement and the profit. So which statement are you going to use? So when you get into a test or examination, make sure you can justify the steps that you are following. What is of most importance to the users of that particular company? We said materiality is based on the auditor's judgment. So for your judgment, make sure you have justification for why you're taking the particular statement that you use. What figures are we going to use as a starting point for us to determine materiality? You're going to ask yourself, has there been significant changes over the years from prior year to current year? Is there anything that has changed for me to select the financial statements that I'm going to use? We are looking for stability, so maybe we have got prior year financial statements, we have got budgeted financial statements for the current year audit, we have got actuals for the current year. We'll do an example shortly. So we are looking for stability before we can select the particular statement for us to use to determine materiality. Are we using actual, budgeted figures, or past results? What is considered appropriate so that we will not miss anything in the financial statements? Materiality, very critical, because that is where the auditor is going to derive their conclusion to say financial statements are materially misstated or they are not materially misstated. Just an example, there's an extract of financial statements. You'll find there's actual for 2017, which has been audited. There's the 2018 budgeted financial statements. There's 2018 actual financial statements. So to determine materiality for the 2018 financial statements, is the auditor going to use the 2017 financial statements? Maybe they will, because these financial statements were audited, they are reliable. 2018 budgeted financial statements, with the fluctuations that are happening within the economy, can they base their materiality on budgeted financials? Budgeted financials against the actual financial statements. Has there been any change? When were we given the actual financial statements? Is this at interim? Is this at year end? So as you make a decision on which set of financial statements you're going to use, make sure you can justify. If you take 2017, it's audited and reliable, that's fine. We are in line with our budget for 2018, therefore I'm going to use budgeted. Actual financial statements are a true reflection of the current operations of the entity, or there's been so much variation between budget and actual, therefore I'm sticking to actual. Within actual, this is a profit-oriented entity. Are you going to use profit before tax? Are you going to take the revenue figure? Justify your choice, because you're saying this particular entity is profit-oriented, therefore I'm using profit before tax. This entity has a huge asset base. It's an investment company. I'm worried about their assets, therefore my materiality is derived from the total assets of the entity. So in an exam, you should be able to justify your steps. You have ISA 320 to guide you. Avoid taking ISA 320 theory and dumping it. You should apply what you've been given in the scenario to the steps that you have in the handbooks. So now you have chosen revenue, you have chosen profit before tax, you have chosen total asset. What range should we use? you're saying what is the overall risk. We say there's an inverse relationship. So there's a guidance to say if you're using profit before tax, 5 to 10%. If you're using revenue, 0.5% to 1%. If you're using total assets, 1% to 2%. If you're using equity, 2% to 5%. And if it's gross profit, 1% to 2%. But initially, you say the risk of this entity is high. Therefore, I'm going to take revenue, but I'm going to take the lower range of revenue. My materiality is going to be based on 5% of their 1 million revenue because the risk within this entity is high. But if risk is low, you can afford to take the upper range to say, I'm going to use profit before tax 10% because my risk is low. So remember, for your selection of the range of materiality, it's also derived by the risk associated with that client. What specific risks should we consider? Should we reduce the materiality level because other risks which might not be reflected in the current levels are within the particular entity? What qualitative reasons do we have to reduce materiality? I have done my calculation and my materiality for entity X is set at 10,000. But could there be any other factors that make me want to reduce my materiality a bit because integrity of management is questionable? This 10,000 might be too high and they could be hiding something within lower amounts. Therefore, I may want to reduce my materiality. What will be your conclusion? Conclude on what level materiality will be set at, and it's communicated for those who are going to perform the audit work. They will need to use that benchmark. For your performance materiality, which we said it's materiality at accession level, you're going to give an overall materiality level haircut and do audit work according to this level. We are saying you determined your overall materiality as 10,000, but then let's just trim this 10,000 by 2% so that our materiality is now lower, and if there are any instances of material misstatements, we will capture them within a lower materiality amount. So, what has been examined previously and what were the common student pitfalls? The required read. Write an email to the board chairman of NAT papers in which you provide a brief overview of how they calculate overall materiality and performance materiality. Write an email to the board chairman of NAT papers in which you provide an overview of how they calculate their overall materiality and performance materiality. You know the steps. ISA 320 will provide you with the steps. But now there's a scenario on the day in the test or exam. It's a scenario on NAT papers. You have to take the information within NAT papers for you to write that email to the board chairman, providing a brief overview of how they calculate overall and performance materiality. Do not just copy the standard and provide them with materiality calculations. Take them through. Given the situation at NAT papers, we are going to select the actual financial statements. Because it is profit oriented, we are going to use profit before tax. Because it has a huge asset base, I'm going to select total assets. Justify every step. Remember, it's applied auditing and you need to apply facts to the theory that you have in the standards. Students were expected to describe the steps that are followed when calculating materiality in performing an audit. Then what happened? Most students misinterpreted this required as they were calculating materiality figures, which was not required. Remember, you are giving an overview of how to calculate materiality step by step. Take them through not to calculate the materiality. So listen to what the required is asking of you. If you need to apply, if on that day you're required to then calculate materiality, you will have to calculate materiality. And you may find that the required will ask you to review a materiality calculation. Now, because you know the correct steps, you know what should have been considered, you know where to start from, that way you can advise on what was done wrong, you can comment what was done well. That is how you will do a review. So listen to what the required is saying on that day and avoid memory dumping. What are the next steps? Go to the module and read course notes on materiality, attempt online quiz questions that we will provide, attempt practice questions from the module, identify issues you're struggling with when attempting questions on materiality, and bring this to your next physical contact class. For any questions, you can contact the auditing department with their details provided. This brings us to the end of the video recording on materiality. I hope you will find it useful. Thank you.